I've been day trading for 10 years, and today I will be exposing the only 3 concepts that you need that took me 10 years to figure out and find out. So I've been day trading since 2014, and we're halfway through 2024, which means I've been day trading. I've been in this game for a decade. I've seen it all from crazy market in 2020 to those bear market, small one we had in 2018 to the current bear market that we just passed in 2022. I've seen it all. I've studied thousands of hours. I've probably studied more than anybody that's watching this video has studied, has watched YouTube videos, courses, traded, lost accounts, made money, done it all. So if you want me to give you the 3 concepts that I think you should be focusing on in 2024 from somebody that has been studying the markets for 10 years, make sure you watch this whole video and you take a bunch of notes. Number 1 is going to be liquidity. This is probably one of the highest concepts that you should be focusing on learning in your journey to be a day trader. What is liquidity, you may ask? Liquidity is what the market needs to move. It seeks the most liquid areas to collect as much orders as possible to then move in a particular direction. Think about the market. Just very simply think about how do you think the stock market moves? Money, right? What is that money? That money is liquidity. More money it has, the more it can move, the more volatile the market is. If you were trading since 2020, the moves were more volatile because people were sitting at home. There was a bunch of money in the markets. Interest rates were low. So hedge funds and institutions could borrow more money, which means there was a little more liquidity. And that's it. The market wants to head to the most areas of liquidity, take it out, and then move the opposite direction, more often than not, or the direction it wants to go to. Liquidity is seen in multiple time frames and needs to be used as a top-down approach to understand where is the most likely targets for price to reach. Liquidity can be used on a 5-minute, 15-minute, hourly, daily, right? It can be used in multiple different time frames, and you can use that liquidity on the different time frames to understand, hey, the daily candle might want to go here. The daily candle just took out liquidity. Maybe it'll close back in the green. The weekly candle might do this. The 5-minute might want to target its lows. Don't worry, we'll go into some charts. If you had your stop loss hit and price went the way you thought it would, congrats, you returned to liquidity. If you cannot spot the liquidity, guys, and this is an old saying that goes in the stock market, if you cannot spot the liquidity, guess what? More than likely, you are the liquidity. Remember that liquidity alone is not enough to take a trade. If you use it to build a bias, and after liquidity has been taken out, you want to see a fast move out of it. This will show you that there were orders that were hit and moved price. This was called displacement out of that area. Remember, guys, liquidity, just because liquidity gets taken out, it doesn't mean you can just enter. This price can flush, especially if there is news or something else that happened, or maybe you just didn't have the right area marked. Price can keep flushing and keep heading in the direction that you might not have thought it gotten. But let me show you guys some real examples. And pretty sure, guys, with every example that I'm going to be showing you is a legitimate trades that I've taken. So what is one of the easiest ways to spot liquidity? What I tell people is the one of the easiest ways to spot liquidity is, 1, look for equal lows or equal highs that have some sort of meaning, or are just multiple equal highs and equal lows within a certain time frame, right? So over here, give you guys like an example. On the 15-minute time frame, we had 2 equal lows. So we had this low here, price came back down, bounced again on the same low. So that means that price had built a liquidity level. So what I would do, I would mark the level that hit equal lows. So exactly the price would have been right here, 5,046. Price went a little bit lower. But what do we see here? We see an aggressive selling into that liquidity level. It's on a 15-minute time frame, right? So you wait for the 15-minute candle close back up, and a big move out of it. So what is here to know? To understand that if you have a good liquidity area marked out, is you have a big move into it. So a big sell, in this case, we had into this area. And this will scare a lot of traders, right? You're like, oh my God, aggressive selling, falling knife, I don't want to buy this, right? And that's a very normal feel to have. And every night I don't want to fight a trend. I want to, I'm scared of this, right? Big red, I should not be buying, I should be waiting. But that's why you have your confirmation, first of all. And second of all, you have to understand the market wants you to feel that. That emotion you're feeling, being scared, the market wants you to do that because it wants you to do the wrong thing. You see big selling here, you want to keep selling it. You sell here because you're like, okay, it's taking out its lows. Let me short sell here. You might enter my short position. We took out the lows, new lows be made. We're gonna go for maybe this low or even lower. My stop loss is gonna be here, and guess what happens? Your stop loss gets hit, and what you thought was gonna be a breakout trade, it was not a breakout trade. You got stopped out. And that's not happen 100% of the times, but that's why you have your confirmation on the 15-minute. And then you could use the 15-minute confirmation to enter. And the beautiful thing about liquidity, it gives you a tight stop loss. So here, let's say you enter long, use that bottom wick as your, remember, there's a 15 minutes to be larger areas. Listing concept applies, and then you target the next liquidity area, which in this case was this multiple highs here. Like, okay, I have multiple highs there. It gets taken out, and you can see here, you never got confirmation. Remember, wait for confirmation. Look, candle closed above it. The liquidity, it means you never got confirmation. And actually now this liquidity area, the orders that were sitting here turn into support orders, and then keeps going in that direction, right? And again, this will work on multiple time frames, right? Depending on what you're trading, liquidity will always be the heart and soul of the market, right? You go to daily, look at this daily level. You had these lows here, this low right here. You can tell this is a liquidity level because if you jump on the smaller time frame, you'll find equal lows at that area. While here you see a big move up. There was no lows to be tested. Price comes, retraces this move, hits that low, closes back above, and keeps going in the current direction. And you'll find that kind of being a pattern all the stock market likes to do. Takes out some lows and then goes higher. Confirmation is not there, and you simply don't want to take that trade. And also use this on the 1 minute. In 1 minute, it works just as good as any other time frame. You just have to understand that when you mess with multiple time frame, guys, it all comes down to, it all comes down to what when you're messing with multiple time frames. That you have to understand, hey, this is a 1 minute trade. More than likely, it's gonna be a fast trade. Look, you had this highs here, just 10:30 highs here. Price comes, takes out the high. And this actually was a short. If remembers in the Discord chat, we had a long here, and our full TP was taking out this high. As soon as we took out the high, big move to the opposite direction, right? Price took out the high, faked the breakout move, and then, all people are like, okay, new high day. Finally broke the high, clear room skies, boom, inverted, and goes down again. This is a 1 minute, so it looks like a little more aggressive move down. But this was a big move down, and this is an actual trade that we looked at. We didn't enter the trade here, but I told you guys the full TP over longs from this move up would have been that area. If you look here, even this long that happened here, we took out this low. We took out this low, and then it bounced back up. You look at it again. Now price builds this low, right? And you can also argue all these lows right here. Price builds orders under it, takes out these orders, and then it goes up. You see on multiple different time frames. And with liquidity, it's all about waiting for the confirmation and using the proper risk reward. Now, we talked about liquidity. Let's talk about the second concept that you should be studying and you should be learning. This is going to be imbalances, also known as fair value gaps, also known as volume nodes. Now, we had talked about liquidity. One another important concepts in the market is understanding where the volume is sitting. Whenever there's a low volume or high volume area, these are called imbalances. The market will seek to fill these imbalances to then eventually correct itself and then continues the overall direction. So imbalances / fair value gap. This is when the market goes impulsively in one direction and leaves an imbalance behind. The market will want to retest the area to fill the imbalance. Not all imbalances are created equal, and we need to know which ones are more important than others. Biggest mistakes beginner traders make is that they believe any imbalance in them is an opportunity to take a trade and cannot find consistency on how to use them. So imbalances, you have to remember, the market wants to be its buyers and sellers, right? It's a market like any type of market. You're selling bananas, you're selling oranges, you're selling potatoes. A market is always going to find a sweet spot, a certain price that it should be at, and based between buyers and the sellers, sometimes there's imbalances, and the market being, it wants to be as perfect as it can, and it wants to fill those imbalances to then continue a certain direction. So let's go over a couple of examples here. This is a 50 million imbalance. As you guys can see, the imbalance gets left behind. Don't worry, we'll go on how to spot the imbalances. It gets tapped, it gets filled, and then it goes opposite direction, and then it went higher. And this is a concept that you can use almost every single day. Now, we're going to talk about why did it not work there? Why did the imbalance go? Need to get fully filled, and then it went higher. Okay, now let's talk about how to draw imbalances and how to spot them. So in imbalances, you're going to need 3 candles, right? So this can be used in any time frame. Everything I teach you can be used in any time frame. So you're going to look for 1 candle, 2nd candle, and 3rd candle. So one of the candles is going to be larger than the other one, which should be the middle candle. The middle candle, the imbalance will only be formed if the previous candle, the low, including the wick, and the third candle, high or low, depending if it's up or down, including the wick, do not touch. So you see here, this and this, that's the exact low, that's the exact high of that candle. We left behind what we call an imbalance. We left behind an area that price was not stable. There was only sellers, right? Price was not able to create an equilibrium within that area. So all of this is your void or your imbalance. So price will seek to come back to this area, as you can see here, test it, and then continue to the overall direction at least once. So you guys can see price comes up, test the zero imbalance. That could be your short entry. And I like to use this in combination with other confluences, such, whatever we like, EMAs, VWAPs, golden pocket, whatever you want. Your stop loss is going to be above the imbalance, a closer above it, and you target your next level of liquidity. This case could have been this lows right here, right? So this is how you draw an imbalance, right? It's 3 candles, and you should get good enough that you can always take a look at it. This is also called a fair value gap, whatever you want to call it, right? And you're going to have to learn on how to spot this. And the best way to spot this is combining it with different confluences, right? So that was your imbalance, and then you're following the overall direction. And also the candles are following the overall, the imbalances are following the overall directions are going to always be the best. As you can see here, we built this imbalance here, and then with this candle right here, they'll actually build its own. Look, if we look here, this is another fair value gap / imbalance. This actually got flushed through, and as you can see, it's because price, the overall direction of the price was to the downside, and that's why it didn't hold up. It's a sign that bearish trend is actually very powerful. And also, just like with liquidity, you gotta wait for the candle closes, guys. Let's see, if you wait for the candle close, you don't enter long here, right? You don't enter long there. Why? Because the candle just flushed through that level didn't hold up, and then you let it keep riding, right? And then you want to combine this with liquidity that we spoke about earlier to make the best out of all of it, and combine all of it. As you can see here, there's a smaller imbalance once the trend start turning to the upside by creating a new high and higher lows, create a bullish trend. You created a small imbalance here that got tapped into and then help to push higher. And you can use this, like I said, anytime frame. I showed you 50 minutes, even on the daily, this will work. On the 50-minute here, this was just a tiny low one. The market closed there, so didn't get respected as much. But these are the levels that you want to look for. For example, here, create this big 50-minute imbalance right there. See on this candle, price comes. This is, I think we had news here from some crazy CPI news, but you can see even here it got tapped and then pushed higher, and then it got flushed through. Lastly, guys, we're going to talk about time and how does time affect trading. So time, you're going to realize in trading that's actually very underrated. You're gonna understand that time plays into the markets a ton, and there's better times to trade than others. So you can combine this with your strategies. You don't want to be trading all day long. If you trade all day long, as a day trader, you're cooked. You want to master what time to trade. Intraday key times that I like to trade is what I call the 10 AM reversal, give or take with both these times about 5 to 15 minutes. So 9:45 to 10:15. Same with 1 PM reversals. They're 12:45 to 1:15. There's also different times that people like to trade. I'm not saying I'm just kind of covering what my strategies are and the best times, whether it's Asia, London, New York Open, which is 9:30. 8 AM is pretty good. 8 to 8:30 AM is pretty good too, and midnight as well. You're going to find that in intradays, these times have the most likelihood for reversals using liquidity and imbalances for it to happen. I'll give you an example. You consolidated until 10 AM right here, and then you made your move to the downside to target to liquidity. Right, so that's when you went sideways, and then finally 10 AM give you that move. Some more example, you get a sell-off. You got a 10, so sell-off in the morning, and then 10 AM bullish reversal after taking out some liquidity. 10 AM reversal again, move to the downside, and 10 AM, and then look at 1 PM. 1 PM back to the downside. So again, you're going to find this is 100% of the times. No, around 70% of the times you'll get one of these two reversals to trade, or at least they're good to look for. Why do these reversals work? more often than not, price needs to build up liquidity towards a direction. 9:30 a.m. to 10 a.m. tends to have the most volume, and during the day, it lets market makers use all that volume to look for a reversal and trap traders in that direction. Happens all the time. They sometimes even call it noob hours, 9 a.m. to 10 a.m. 1 p.m. is when a lot of hedge funds / market makers come back for lunch. So all those are programmed to often take price a different direction around that time because they come back. And that's just the way it moved. It sounds silly, but it works that way. Other confluences, I do not only use time to look for potential entries, but do use time as a confluence to look for entries with other things that we talked about. I like to have at least 2 to 3 confluences before taking any trades. Look for divergences, imbalances for value gaps, liquidity, or Fibonacci tracements. Other time frames and forms of time. Another way you can look at time on the micro scale, because I like to give you guys both the micro, which is intraday, and also the macro. Time can be used on seasonality of the stock market. So the likelihood seasons or months that the market tends to go up or down overall, and done by case studies. And here you can go on equityclock.com and look at it on a deeper level. With this example, we can go look at some times as well on random days. So we'll go on this past Friday right here. We'll go right here. You see right here around 10 a.m., 10:15, price tends to went up, came back down. I'll cut it out. Let's go to 5 minutes. All right, so now let's look at some example. We'll go somewhere in the days. Right here, you can see that price consolidates from, we got the 9, this was a little funky because you had CPI here, but price goes up, consolidates for a while, 10 a.m. hits right here, and then goes up to that direction, right? Then you go down, and then 1 p.m. around here is 1 p.m., and you make your move down to get the liquidity, and then here it also FOMC. This was on a Wednesday. There was a wacky, crazy day, but here, cleaner example, when there's not as many news. 10 a.m. big move down, 10 a.m. happens, and you get your move up, right? So use it alongside with other confluences. Again here, price moves down, 10 a.m. Look at 10 a.m. Starts making your move up, right? Go here, 1 p.m. roughly, price starts going down. Here's it again, and 30 and 35 and 45. Price will go up around that 15 minutes before and after. Right here, kind of again. And then we start seeing it. You start noticing a pattern. So people can look right here, 10 a.m. Move down, goes right back up. It'll be a sideways day, but regardless, you'll get a move one of the 2 directions. So all in all, what you gotta do is combine time, liquidity, imbalances, focus on these 2 things, see how they correlate together, mesh them together, find some other confluences in there that you like, and I promise you'll see yourself a ton of years. Because I've been here for 10 years. If you want to rely on me every single day, learn from me, make sure you hit the links down below, join the group, and I'll be to see you there. Peace out.